Welcome back. We're going to start our oil and gas series with Exxon Mobil, XOM. They have a $260 billion market cap and are selling for $61 a share. This one was a request, so if you have any other requests, please leave them in the comments below. So first we're going to start with a brief look at the share price history and some of the ratios, and then we're going to do a deep dive into the financial statements. So let's get started. What I have here is about a 5-year history of the stock price. So you can see over 5 years it's down 33%, so you've lost about a third of your investment if you bought 5 years ago. Hopefully by looking at the financial statements, we'll be able to answer, is that justified, or better yet, is it set to climb back up to those high values? So let's get started. First up is the income statement. And the first thing we look at in the income statement is always total revenue, the top line item. What do I always say? I always say you want to make sure it's not decreasing. Well, ruh-roh, it is decreasing. But recently, look at this. Recently, it is climbing up, so that could be a good sign. So we'll keep that in mind as we continue. All right, next up, gross margin. For manufacturing companies, I love looking at gross margin to get an idea of their competitive advantage. This is scary. I don't know what the heck happened here. How did we have a minus 40% gross margin? To put that in context, that means that all your revenue was less than it cost you just to buy the raw material. So not even counting any of the other costs. Now, we all know that this is the COVID quarter, and I suspect we're going to see a similar pattern with all the oil and gas companies. So we'll take that with a grain of salt. Recently, gross margin looks good. It's been growing. Be nice to get back to these levels, 15 years ago, but I don't think that's going to happen anytime soon. All right, let's go to pre-tax income. So the pre-tax income kind of follows that same pattern as the revenue. We have the COVID quarter here, and then we have a recent rise. So is it going to continue? Maybe, but what we're going to do is look at the last 3 quarters here, and I'm going to get an average number, and that's going to be what I use for my valuation. So if I take the average of the last 3 quarters, the average value was 6.5 billion. So if I do up here in the calculator 6.5 billion per quarter times 4 to get a yearly number, that's going to be my yearly pre-tax income estimate, so 26 billion. All right, let's do growth. So it's tough to do growth with a company like this because it looks like it's shrinking, but recently it is growing. So what I'm going to do is do the 5-year method that we do for almost everybody. So if you look back in 2015-16, they were making about 5.9 billion per quarter. And now we just said our average is 6.5. So I'm going to do 6.5 divided by 5.9 and then raise that to the 1/5 because it's over 5 years. And we're going to get a growth rate of 1.95% or 2%. I'm going to round up. That's a little conservative, but I always like to be conservative with my growth rates. Y'all know that. Moving to earnings per share. We are going to take the trailing 12 months. That's what we normally do, except if I did that, I would include this horrible negative, and I think that's an outlier. So I'm going to do something similar to the pre-tax. I'm going to take the average of these last 3 and multiply by 4. So if I do that, the average of the last 3 was $1.1 per share per quarter. So 1.1 times 4, 440 is our earnings per share, 4.4. All right, that's the income statement. Let's go to the balance sheet. Total assets. I know I usually look at total tangible assets. In Exxon's case, there's really not a lot of intangible assets or goodwill, so I'm just going to do total assets to keep it simple. I think the goodwill or intangible assets is like less than 2 or 3% of their total assets. All right, so our first thing that we're going to do is get a pre-tax return on assets. So what we do is we take our pre-tax number that we got, the 26 billion, and we divide by the current total asset. So if I scroll down here, the total is 337. So 26 divided by 337 is 7.7%. So I'm going to put 8%. That's not great, but I think it's going to be on par for other large manufacturing or other large oil and gas companies. Next, I want to show you total debt because I thought this was pretty interesting. Okay, so look at this. During COVID, they went into a huge amount of debt, went from, $50 billion to $70 billion in debt, but since then, they've been paying it off. So look, I love increasing earnings and decreasing debt. That's a healthy sign for a business, and it would make me feel good if I was a shareholder. All right, let's look at our book value per share. So this is all the assets, everything the company owns, minus all the liabilities, everything the company owes, and then we divide by the number of shares. So we like to see this growing because this is a good way to measure the net worth of a company. So just like in personal finances, even if you're making a good salary, if your net worth is going down, you're kind of just running in place. You're not going anywhere. Similar thing to public companies, except you have to account for dividends. So if the company is known for paying dividends, you can't really get upset with them if their book value per share isn't rising. And I know Exxon does do dividends, so we're not going to jump on them about their book value per share being kind of flatlined or even decreasing a little bit, because as you're going to see, they pay a huge percentage of their free cash flow out in dividends. All right, so what we're going to do here though is get a return on equity. Since this is our book value per share and we're doing a return on equity after tax, we're going to take our earnings per share after tax, that 440, and divide by the most recent one. So 440 divided by the most recent one, which looks like it's about 38, so 38, and we get 11.5%, so gonna round up, 12% return on equity. That's not terrible, but it's not great either. I would say it's in kind of the okay zone. Let's move to the cash flow statement. All right, so first up is free cash flow. This is all the cash coming in from operations minus all the capital expenditures. We don't like to see this decreasing, but recently it's been on an upswing, so that's a good sign. If this continues rising, the stock will definitely reflect that. So what am I going to do here to get my number? I'm going to do the same thing I did for the pre-tax and the earnings per share. I'm going to take these last three right here, take an average, and multiply by 4. So if I do that, the last 3 quarters, my average is $7.6 billion per quarter, so 7.6 billion times 4, and I get 30.4. Round down, just keep it simple, 30 billion. All right, let's look at dividends. Y'all know increasing dividends are great. It means that the company has increasing confidence in its own business. I will say though, it's pretty strange that their income was decreasing, their free cash flow was decreasing, but they were increasing their dividends. That makes me a little suspicious that they could be trying to keep shareholders happy in the short term instead of trying to make more money for the shareholders. It's a really fine line, but it does confuse me, especially that they paid it during that terrible quarter. All right, rant incoming. This is kind of a pet peeve of mine. Companies are terrified to decrease the dividend because they think it might hurt their share price, but the share price does not really affect the intrinsic value of the business, right? So if they can increase the intrinsic value of the business by pausing the dividend for a quarter or two, because at that time they could use that cash instead of sending it out, they could use it to reinvest and keep themselves from going in debt, or better than that, capitalize on a dip in the market. That would do much more for the intrinsic value of the business than paying out a dividend because you want people to be happy in the short term. So it does frustrate me a little bit, and I think that companies are underestimating their shareholders whenever they do stuff like this. Or it's management that just has very short-term incentives and is trying to keep the stock propped up for their stint while they're in control. So look at this. So what? 3.7 billion per quarter, 3.7 times 4. That's $15 billion. That's half their free cash flow that they're paying out in dividends. That's great, but at the same time, it kind of frustrates me that they had that period where they went into a bunch of debt, that they had that period where they were losing money and continuing to lose money, but they kept on propping this up. Red flag for me. But it is what it is. Real quick, we're going to look at share repurchases, because this is a good way to tell if a company thinks their stock's undervalued. I'll say this, a company that's repurchasing shares usually thinks the stock's undervalued. Just because a company is not repurchasing doesn't necessarily mean it thinks the stock is undervalued. So they're not repurchasing, they were, and they're not. That's not a great sign, but it's not that bad either. So I'm not going to harp too much on that. Let's go to valuation. Let's get a number for these guys. All right, first one, pre-tax method. Pre-tax times 10 divided by the number of shares. So 26 times 10 divided by the number of shares, 4.23. $61 a share. Right on with the share price. Nice. All right, next formula is going to be our Ben Graham formula. Earnings per share, so 4.4 times 8.5 plus 2 times your growth, so 2 times 2. And we get $55 for that price. And lastly, we're going to do our DCF, or discounted cash flow. So our free cash flow was 30 billion. Our perpetual growth rate, I'm going to keep it low and do 2%. And then my discount rate, always 15%. All right, and we get a net present value for the market cap of $265 billion. So I do 265 divided by the number of shares, and I get $63 per share as our target. All right, so all of our target prices and the average comes in right at the market price. It's definitely selling at a fair value. If they continue to grow their income and they continue to grow their free cash flow, the intrinsic value is going to continue to rise and the share price will reflect that. in time. For me, I don't think there's a margin of safety between the intrinsic value and the share price to dive in right now, and I'd want to look at the other oil and gas companies before I made a decision if I was going to invest in oil and gas. And those will be coming in the next couple of weeks or so, so stay tuned for that. If you did learn something in this video, if you enjoyed it, please like and subscribe, and I will see you next time.